if you haven't seen in the news, Buffett has sold $7 billion of Bank of America stock since July, basically taking himself down to the point that now he has about 11% of total ownership of the stock. And he's soon about to be below 10%, where he won't have to tell everybody every single time that he's selling the stock that he's selling the stock. But I mean, you look at it, right, at least in terms of from a stock chart, it doesn't look like it's been doing poorly in terms of Bank of America. So, right, it begs the question, what is Buffett thinking? And if you look at it, right, let's jump in and see on a uniform accounting perspective. And this one's a little bit different from the other ones that we've talked about because this is a bank. So we're going to look at what we call return on equity as opposed to return on assets. But we can talk about that. Joe, you want to add anything before we jump in?
Yeah, just one, Bank of America stock has gone up something like 15 to 20% as Buffett's been, unloading it. He still owns 11% of the company. Berkshire Hathaway still owns 11%. So it's still a gigantic. It's not like he has dumped $7 billion, but he's still holding 11% of the firm. So it's not like he dumped it all. That's one. Two, he also has dumped all the banks. Not dumped, but he's been selling banks across his portfolio over the last year or so, right? So he had Goldman Sachs. He's been selling that. He had JP Morgan, I believe. He was selling that. I believe he had some Wells Fargo, I think, that he sold. I believe, if I go back right far enough. But either way.
American Express, too, I think, yeah.
And so I think this is a call he's making a bit more about the whole sector than it is Bank of America specific. And for that reason, we want to take a look at the altimeter and say, all right, so what are we seeing in terms of return on equity and performance on a uniform basis? Because again, as you know, Buffett would never look at GAAP accounting calculations. He says it in the first 5-10 minutes of every one of his annual shareholder meetings. Charlie agrees with them. He says, don't look at that bottom line. Don't look at GAAP numbers. They've messed up, and they've certainly messed up for banks. And so we want to look at return on equity without that, and here's what we see.
Yeah, and what we see is if you think about it in the context of exactly, right, Joel, what you just said, in terms of this has been a call that he's had for the overall sector. You can see, right, I think what he's probably looking at is when we look at a uniform accounting in terms of return on equity, we can see, right, return on equity that peaked right around, call it 17%, and is forecast to fall to, it fell to 13%, 12.5%, and it's now forecast to drop again in 2024. What Buffett's probably seeing is on a real return on equity basis that these companies are actually being under pressure. And if you look, right, it's not like it's an expensive stock that he's selling it because it's expensive. It just seems to be what Buffett is saying is, hey, look, it's the same context of why, when you look at him raising all of the cash that he's raised, that he's sitting on the biggest biggest amount of cash he's ever sat on at Berkshire Hathaway. I think he's looking at the consumer, right? And knowing that Bank of America actually has a really lot of consumer exposure. And saying that's going to be, right, in terms of consumer credit is going to be a tough place for them. And CRE is going to be a tough place for them.
Commercial
and if I think of...
Right. Is still in the middle of a 10-year depression in the middle of. This is not like commercial real estate is going to rebound sometime in the next year, right? This work at home or work anywhere but the office. It's really not work at home because people are working everywhere. It's just don't work at the office is hitting at such levels, and we're still in the middle innings here. This is not by any means the bottom. And so given that the banks have a lot of commercial real estate loans that they've been playing some very smart financial engineering with to push them out and extend and pretend, there's still going to be another shoe to drop there at some point. And why would Buffett want to be holding it? And that's a bank sector-wide issue. Rob, you're going to see a third thing that's a problem at Bank of America.
Yeah, the third thing is, when you think about Goldman and you think about Bank of America especially, is also just, right, these are big investment banks, right? Bank of America with Merrill Lynch and Goldman, obviously that's their primary driver. And also I think looking at the idea of if interest rates, even when they come down, aren't going back down to zero, but right, are going in the fours or whatever else, it's not like we're going to have an M&A boom. And it's not like we're seeing trading volumes massively accelerate when you talk to any of those. And I think that he's looking at, you think about the three biggest parts of each of their businesses, and he's saying, yeah, the three parts of your business aren't going to be looking particularly good. So even though, right, and this comes the idea of these white bars again with the market's pricing in, the market's pricing in some return on equity rollover for this business already from low levels. I think what Buffett's looking at is he's saying, yeah, and maybe for the next 2 to 3 years that might make sense. And so let's redeploy elsewhere.
And maybe it's a little worse than what the market's pricing in right now, given the stock's up 18%, right, at this moment. You might just be saying, let me get while the getting's good, Dean. And a lot of times, our clients, because we do have, some of the biggest institutional investors in the world using our work, And, it sometimes comes down to it's just, they want 3-to-1 upside versus downside. They're not trying to make bets that are, they want asymptotic, or they want asymmetric bets where they're like,
Asymmetric,
look,
yeah.
asymmetric, what's the amount that it could fall? And what's the amount it could go up? And if I can't reasonably think that it could go up 300% versus fall 100%, I'm just going to get out. And so as that changes, you start unloading. That doesn't mean the stock is going to drop tomorrow. Now, we don't know some people that have been saying Bank of America has got a lot more sitting on its balance sheet that is nasty, that it's sitting on a lot more loans that are bad. There are people saying that. I don't necessarily feel that way. I'm simply saying this could simply be, you know what, if this is even money, it could be there's upside, could be there's downside. That's not a reason for Buffett to hold the stock. He wants to hold stocks that have at least, they'd argue 3-to-1. I say they, our institutional investors, our big clients would say 3-to-1 upside versus downside. And at this point, you're like, do you really think that it's going to suddenly turn around? Commercial real estate loans are all going to get paid back. The consumer is going to start paying credit cards on time and not be more delinquent, Rob, as we've talked about. That, whatever Bank of America has exposure to auto loans or whatever, because auto loans are getting more delinquent. When you look across the board, it's a little bit worse than it is better in consumer debt. And business-to-business debt also, there's issues when you think about commercial real estate being, if you will, business-to-business debt. So, it could just be Buffett's own money because he's like, you know what, I just don't see the upside of 3-to-1, and I want 3-to-1 upside. And that might be enough reason to sell versus thinking, oh my goodness, Buffett's, there's so many YouTube videos. Buffett's selling, it's a crash, Bank of America is going to go bankrupt. And it's like, no, it could just be that he's like, it's even money, so why should I hold even money?